So, SoFi Technologies, you know them, SOFI, has been on an absolute tear, right? And it's leaving a lot of us wondering, hey, have I missed the boat? But what if there was a way to get in, not at today's high price, but at a level where the big institutional money has consistently stepped in to buy? Well, in this explainer, we're going to break down exactly that kind of strategy.
So, picture this. It's April 15th, 2026, and the stock is just flying high, trading around $18.45 before the market even opens. That's a huge jump, showing some serious momentum. Now, that's the kind of strength that gets everyone's attention, but it also creates a classic problem.
And that right there is the central dilemma, isn't it? When you see a stock taking off like this, that fear of missing out, FOMO, it's powerful. But so is the risk of buying right at the tippy top, just before a potential pullback. So what's the smart move here?
Okay, so here's our game plan. First, we'll tackle the surge and the dilemma it creates. Then, we'll dive into the proposed trading strategy. We're going to look at what's driving all this bullish momentum, explain why this specific strategy makes sense, crunch the numbers, and finally put it all together. All right, let's dive right in. First up on our agenda, really understanding SoFi's surge and why it puts investors at this classic crossroads.
Okay, so here's the deal. The stock's momentum is undeniable. It's breaking out and it's strong. But that very strength has pushed it into what traders call overbought territory. Think of it like a rubber band that's been stretched way, way too far. It suggests the buying has been super aggressive and the stock might be due for a breather or a pullback. Buying it directly right now could be just bad timing.
So how do you play this? Do you just sit on the sidelines and watch? Well, according to the source material we're looking at, instead of chasing the stock, there's a specific option strategy that could give you a real strategic edge. Let's take a look at the trade they're proposing.
And that strategy is selling what's called a cash-secured put. Now, looking at the table here, the idea is to target the May 15th, 2026 expiration with a $17 strike price. The goal is to collect a premium of about 95 cents per share for selling this option. Now, hang on. If cash-secured put sounds like a foreign language, don't you worry, we're about to unpack exactly what this means and why it's so powerful in this situation.
But hold on a second. Before we get into the how, we need to talk about the why. Why are we even bullish on SoFi in the first place? Well, the analysis here points to some really specific technical and fundamental signals that are fueling all this optimism. Let's decode what's really behind this rally.
Okay, now this is where it gets really interesting. It's not just one thing. It's a whole bunch of things coming together at once. Technically, the stock just shattered a multi-month downtrend. That's a huge change in character. It also blew past that key resistance level at $18. And check this out. The trading volume, it's 50% above average. That tells you this is likely institutional accumulation. The big money is moving in. On top of that, the whole story around the company's profitability is shifting. And with earnings just around the corner on April 29th, there's a clear potential catalyst on the horizon.
Okay, so the outlook is definitely bullish, which brings us right back to that big question. If it's so great, why not just, buy the stock? Why go through all this trouble with an option strategy? Well, this is where the real genius of the plan comes into play. All right, quick definition time, so we're all on the same page. A cash-secured put. It sounds complicated, but it's really not. All it means is you're selling a promise. You're saying, hey, I'm willing to buy 100 shares of this stock at a certain price if it drops. And just for making that promise, you get paid cash right up front.
And this right here, this is the aha moment. Look at this comparison. You could buy the stock right now at around $18.45, or you could sell the put. Your potential entry price drops all the way to $17. And here's the kicker. Instead of paying money, you receive money in the form of that premium. You are literally getting paid to wait for a better price. How cool is that?
Okay, I know that sounds almost too good to be true, so let's crunch the numbers step by step and see exactly how this lowers your potential cost.
So first things first, we start with that $17 strike price. That's our line in the sand. That's the price we're saying, you know what? I'd be more than happy to own SoFi at this price. But like we said, you don't make that promise for nothing. For taking on that obligation, the market pays you. In this case, you collect a premium of 95 cents per share, cash in your account, right away. And that cash immediately starts working for you. The math here is super simple, but it's incredibly powerful. You just take that $17 strike price and you subtract the 95-cent premium you just pocketed.
And voila! That gives you your effective cost basis, $16.10. So let that sink in. If you do end up buying the shares, this is your real price, not the $18.50 it was trading at, $16.10. That's a massive discount.
Okay, so $16.10. What's the magic behind that number? It's not just something pulled out of thin air. Let's put this all together and see why that specific price is so important.
And this, right here, is the key that unlocks the whole strategy. The source material points out that our calculated cost of $16.10 isn't just a random number. It's a price level that has historically been a major support zone, a strong buy zone for the big guys, the institutional investors. So you see the beauty of this, right? It sets up two potential ways to win. Scenario 1, the stock dips below 17. Awesome. You get to acquire shares at a price where the big money has historically loved to buy. Scenario 2, the stock stays above 17. The option just expires and you get to keep that 95 cents a share as pure profit. It's a fantastic win-win setup. Which really leaves us with this one last thought to chew on. In a market where picking the perfect top or bottom feels totally impossible, could getting paid to wait for your price be the ultimate trading edge? You know, instead of anxiously chasing a stock that's running away, you're calmly setting your terms and collecting income while you wait for the opportunity to come to you. It's a pretty powerful shift in perspective, isn't it?